right, so what makes you a first-time home buyer? Who is a first-time home buyer, right? A first-time home buyer is a person who has not owned or had ownership in a residential property within the last 3 years. That also includes a person who's given up ownership rights due to a divorce or domestic violence. And then, first-time home buyer is also a person who does not own a second home, vacation home, or investment property either in the U.S. or abroad. So, if you haven't had a house anywhere, the U.S., outside the country, you're considered a first-time home buyer, and then you qualify for several programs that first-time home buyers qualify that others wouldn't, since they wouldn't be considered a first-time home buyer. All right, so determining affordability. So how much home you can afford depends on many things. The biggest ones are income, debt, mortgage type and term, interest rate, and taxes and insurance. So I'll break that down a little bit for you. So affordability, right, we look at your income versus your debt. So what that means is we look at all your monthly debt. We take all those minimum payments that you have to make on those credit cards, auto loans, any personal loans that you may have, and we divide it by your income. And if it's under, so like I said, there's different products, but mainly if it's under 43%, you'll be able to qualify for a certain amount that we calculate. So I'll go into a little bit more detail in the next couple of slides, but income and debt is very important into determining how much you're going to qualify for a home. Mortgage type and term. So there's different mortgage types and terms. So you may want to do the standard 30-year mortgage. Some people like to pay off their mortgage a little bit quicker, so they choose to do maybe a 25 or 20-year mortgage, or they even go less down to a 15 or 10-year mortgage. Something to think about: if you're doing one of those 10 or 15-year mortgages, your payment's going to be a lot higher, since instead of paying your mortgage in 15 years, instead of paying off your mortgage in 30 years, you're not paying it in 15 years. So you're shortening the term, so that means your payment's going to be a little bit higher. But the biggest advantage to that, right, is that you're going to be paying off your mortgage in 15 years instead of 30. So it all depends on your budget and your flexibility. A lot of people like to do the regular standard 30-year mortgage because their payments can be a lot lower. But like I said, some people like to pay off their mortgage a lot quicker, don't have to think about their responsibility in their head, and they choose a lower term such as 15 years. Interest rate. Interest rate right now is at an all-time low. If you go back 10 years from now, a standard interest rate on a mortgage was between 6 and 9%. When we think of those numbers today, those numbers are crazy. They're ridiculously high. To give an example, today the mortgage rates are around 3%. So we're a third of what we were 10 years ago. So that makes a huge difference. And taxes and insurance. So your taxes are a big one. If your annual taxes are very high, that means that you're going to be able to afford less, because we take your taxes in consideration to your payment. And I'll show you, we have a slide coming up that will give you a breakdown of what the mortgage payment consists of. But taxes are very important. You want to make sure that you're not buying in a county or in a town that taxes are too expensive, because that's going to make a majority of your mortgage. You might not be able to afford something that's in a different county that taxes a lot less. So taxes are very important. Same thing with insurance. Insurance, right? Insurance covers, for example, right? We just had this huge storm here in New Jersey, pretty much all over the U.S., right? Hurricane Ida. So insurance is very important, because all those people that got flooded in their house, if they didn't have the right coverage, they weren't covered for compensation for all those items that they lost. So once you start the process with us, right, we'll make sure that you have the right coverage on insurance, and we'll advise on taxes on if this is affordable or not. And then the biggest thing when talking about credit, something that you can remember that's very simple, is called the 4 C's. All right, so Toby, do you want to read out the 4 C's for us?
Sure. So the 4 C's of credit, the first one is capacity, present and future ability to meet payment obligations. Keep reading.
Yep, you can go ahead and read all 4 of them.
Okay, the second one is capital, which is the value of assets. And that is cash, savings, investments, properties. Credit is the third C, which is how responsibly bills and debt have been paid. And the last one is collateral, which is the property or other assets offered to secure the loan.
Perfect, thank you for reading that. And yeah, just like I mentioned before, income, debt, interest rate, insurance, that all goes in effect, and it's very important. All right, we're gonna jump to the next one. The next slide is very interesting, and pay a lot of attention to this slide. So as you see on the screen, there are 4 different options. There's an FHA loan, VA, standard conventional loan, and a renovation 203K loan. So each of these programs are something that we offer and something that has different needs, different fits for everyone out there. The most common type of loan that we have out there is called the FHA loan. FHA loan is a great product if you're just starting to build credit, because as you see, minimum credit score for an FHA loan is 580. 580, right? That's very low compared to what other lenders or what the industry is asking for. With an FHA loan, you will see that your minimum payment has to be 3.5%. 3.5% is still very low, and it's 3.5% of the sales price. So if you agree to purchase a home for $200,000, know that you will have to put $7,000 as a down payment. That's 3.5%. If you're in the military or you're retired, armed forces, anything, in terms of the military, you may qualify for a VA loan. VA loan it's a great product, but only certain people qualify for. Same thing, minimum credit score is 580. It's very low. And the minimum down payment for a VA loan is 0%. You do not have to put anything out of pocket. And if you go back to the top 2 squares, right? Housing ratio and debt to income. So those 2 are very important to determining how much you're able to afford for the home. So once we get a hold of your employment, once we get a hold of all your liabilities, all your debt, we'll be able to see the ratios, and we'll be able to let you know, yes, you may qualify for this amount, or no, because your debt to income ratio is above 50%. So that's something that we will determine once we're going through the whole pre-approval process. A very common mortgage product out there, it's a conventional loan. A conventional loan is very common. It's what a lot of people like to use, especially because on this one, right, your minimum down payment is anywhere between 3 to 5%. Depending on credit, right, you can be on that lower side. You can put down as little as 3%. But with this product, credit has to be a little bit better, and it has to be at least 620. The FHA and conventional loans are the 2 popular ones. One is a 580 credit score, FHA. Second one, standard conventional loan, it's a 620. The biggest difference between these 2 products is that certain people, certain sellers don't want to go through an FHA loan versus a conventional loan. So, and the reason for that is because for an FHA loan, they're a little bit more strict, and the process may take a little bit longer than a conventional loan. So FHA loan, right, can take anywhere between 45 to 50 days, but you're looking at a standard conventional loan that can take 30 days. So a lot of home buyers right now definitely want to get out of their homes as soon as possible. So when they see an offer saying that it's a conventional loan, sometimes they prefer to take that one over an FHA loan. And then a very important product that we do have to offer as well, it's called a renovation 203K loan. 203K loan can be used for, if you're looking to purchase a property that needs major renovation, such as, it's missing appliances, you're redoing the kitchen, there's any structural damage, the garage in the back is falling apart, you need to renovate it. So that's what a renovation loan is used for. And same thing, those are very popular types of products that we have. Same thing, credit score is 580. It still falls under that FHA bucket. It's still considered an FHA loan. Down payment is the same at 3.5. And the debt to income is the same thing as an FHA loan, right? It's 50%, up to 50%. And I'll go into a little bit more detail later on in the presentation. All right, so this slide that we're going to go over is determining what a 30-year mortgage should look like at a loan amount of $250,000 with an interest rate of 3%. All right, so all these things right here, mortgage insurance, principal and interest, homeowners insurance, and taxes makes up your monthly payment. So if you look at the big circle on the screen, the majority of your payment is going to be principal and interest. So principal and interest, right, in this example, it's 55% of your mortgage payment. 29% is your taxes. 5% is your homeowners insurance, and 11% is your mortgage insurance. So to give you a little breakdown, so in this example, we're looking at a total monthly payment of $1,848 for a mortgage. That's $250,000. So pretty much, let's just say $1,850 a month. On the chat box, right, you can let me know how much you guys are paying in rent. How does that compare to what you guys are paying in rent?
Come on, guys. Are you with us, guys? How much are you paying in rent right now? We see that Jason is saying if you have a loan of $250,000, your mortgage on that property will be about $1,850. If you're paying close to $1,850, give us, let it keep it coming in, $1,500. Okay, that's close. Okay. So this is for, I'm guessing this is for a single family home, right, Jason?
Correct. This example, right, we're looking at single family home. Taxes are about $6,000 a year.
So and that would be like how many rooms?
So on average, right, for this loan amount, you're looking at 3 bedrooms, 2 bathrooms on average.
Okay, so if you're paying close to between 17 and 1,800, let's make it easy. Give us a 10. I like the number 10. Maybe that's my lucky number if I got to play lotto. I don't play anyway. So, but anyway, if you are paying close to 1,700, 1,800 and rent, give us a 10. If you are less than 1,500, give us a 7. Okay. All right. So for those paying that are close to 10, you know that you should be building your own equity and not that landlord's equity. Right, Jason?
Exactly.
I hope you get to explain what that equity means to them.
Yes, we will go over that.
All right. Thank you. All right. Let's keep moving.
Perfect. So yeah, so a lot of people, are close to that $1,800 range. And then I saw someone in the chat saying they pay $550. You have to let me know where you're paying $550 because I'd love to pay that little a month. Perfect. So what is a good credit score? So credit score generally ranges from 300 to 850. Like you saw on the previous slide, right? Mortgage programs generally require credit between 580 or higher. 580, right, is very low. M&T is one of the only lenders out there that have a 580 credit score or higher program. Most of them are 620. Borrowers with higher credits or can take advantage of more options, like we saw in one of the programs before. If your credit score was 620, you're able to qualify for that conventional loan instead of an FHA. So that's what means when you have a better credit score, you may qualify for more products. And even if your credit score is not 620, right, we can always put you in a program. We're able to find a product for you, or we're able to help you improve your credit score so you can be able to meet the program guidelines for that certain product you're looking for.